Okay, so this is the 2023 costing question. So it was a mix of marginal and then um, marginal and absorption question there in part B. So part A, Wilson Limited produces a single product. The company's profit and loss account for the year ended 31st of the 12th, 2022, during which 80,000 units were produced and sold were as follows. So you can see here that they've got sales 80,000 units, 2160000, materials 420,000, direct labour 376,000, factory overheads 340,000, admin expenses 152,500, selling expenses 182,750. So in total, all the expenses there 147,150 and net profit 688,750. So the materials and direct labour are variable costs. Okay, so materials and direct labour are variable costs. Now, apart from a sales commission of 5% of sales, selling and administration expenses are fixed. So, administration expenses, right, that is fixed because any sales commission is going to go into the selling expenses. Okay, so 5% of sales, 2160000 of sales, right? That is going to be 108,000. That is the sales commission, okay, of that. So 108,000 is variable, and then the fixed is just whatever is left. So 74,750. So 74,750. Okay, so just to remind you, sales commission, that is a selling expense, so it's not an admin expense. So they're trying to put you off using that sentence there. Now it says the factory overheads are mixed costs and have behaved in the past as follows. So that means that there's going to be an element of variable and there's going to be an element of fixed in the factory overheads. So we are going to use the high-low method, and they're asking us to do this in part A and to show our workings to calculate the variable and fixed elements of factory overheads. Okay, now sneaky here that they're asking us to show our workings because we could do it easily without showing our workings, but look, we'll get started and showing our workings here. So we're going to use the high-low method. So it is high minus low is equal to the difference. Okay, so we're going to have the units and we're going to have the euros. Okay, so the units, we've got 100,000 units, and then we've got is the high, and then 25,000 is the low. So 100,000 is the high, 25 is the low. In euros, we've got 420 high, 120 low. So this goes by the the understanding that obviously, any difference between the output here has to be variable because the fixed is going to stay the same. It doesn't matter what the output is. Okay, so fixed stays the same, it's only going to be variable that changes. Okay, so 420 minus 120 gives me 300,000 there. So the difference between 75,000 units is 300,000. Okay, so if we take 300,000 into our calculators, divide it by 75,000 units, that's going to tell me that the variable cost per unit is €4. Okay, so let's remember that any difference between the costs here has to be variable because fixed will always stay the same. Okay, so for us now to find the fixed, right, what we'll do is we'll take the total costs, which is 420, 300,000 and 120. So I'm taking all these here, okay? And at the units, the 100,000 is 420, so that's units. Okay, and then 70,000 units. And then 25,000 units. Okay, and then if I take away the variable costs, so variable cost there would be 400,000. If variable cost there, 70,000 or 70,000 multiplied by 4, 280,000. And then 25,000 multiplied by 4 gives us 100,000. So you can see the trend here. That means that is a fixed cost of 20,000 across the board. And so that is us showing our workings. You could very easily do that without showing your workings, just doing it on your calculator. But because they've told you to show your workings, that's quite annoying there. You actually have to show your workings. Okay, right, so what we're going to do now, we're going to do part 2, which is say calculate the company's break-even point and margin of safety. Explain what's meant by the margin of safety, blah, 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 blah. Part 3 and part 4 are all sensitivity analysis as well. So unfortunately, what we have to do now, we have to do a marginal costing statement. Now, this isn't bringing us any marks really, but every costing question, we have to do a marginal costing statement. Okay, so bit of work here, but it's going to pay off then. It's going to pay off during the question. So we've got sales, so 80,000 units, 216,000. Then we're going to split up the different types of costs. So that's what a marginal costing statement is. We're going to take away the variable costs first. Okay, so we know we have our materials, 420. So I'm just taking these from here. We've got our direct labour, 376. We've got our factory overheads. Okay, so our factory overheads, I wrote down 4,000 euro there. Should have just been 4. I don't know why I wrote down 4,000 when it was 4, and then the fix there is 20,000. So the factory overheads will be 80,000 multiplied by €4 per unit. So that is 320,000 euro. Then I'll do the selling expenses part of that. Okay, so selling expenses. So that's all my variable costs. The rest of them are fixed. So 108,000 there. So 420 materials, 376 labour, factory overheads 320, selling expenses 108. We fire all of that into our calculators. We get 1224000. Now, in marginal costing, our sales minus our variable costs is equal to our contribution. Okay, so contribution here, 2160000 minus 1224000 gives me 936,000. Okay, then what I'm going to do after I've taken my variable costs away is take away the fixed costs. Okay, so less fixed costs. So we've got then the factory overheads, the 20,000. Okay, so 20,000 there. We've got the admin expenses, 152,500. And then we've got the fixed element of the selling expenses. So that is 74,750. Okay, so 74,750. Now, when we add all of them then, that is the total fixed costs. All right, so that is 247,250. Okay, and then we take that away from the contribution and we get our net profit. So our net profit, 936,000 minus 247,250. That gives me 936, I put it into the calculator wrong. 936,000 minus 247,250. Okay, so just shows you I put it into the calculator there wrong. You need to check everything twice in an exam. Okay, so look, I knew I had it wrong. I would double check, but it should be the exact same as the net profit there. Okay, so it shouldn't change from the net profit in the question. All you're doing here is you're separating your variable costs from your fixed costs and just showing the contribution like that. Okay, now What you also have to do here is you also have to find out what is the crack per unit. Okay, so you need to say, okay, well, how much is the selling price per unit? How much is the variable cost per unit? How much is everything per unit, right? So the selling price per unit would be 2160000 divided by the 80,000 units. All right, so that is €27. The variable cost per unit would be the 1224000 divided by 80,000 units, which is €15 and 30 cents. Okay, and then this is called contribution per unit, would be the 936,000 divided by 80,000 units, and that is €11 and 70 cents. Now it's also €27 minus the 15.30. It's also that as well. Okay, now that's all we can do for all the per unit, but we need to note that this is the total fixed cost as well. We're going to use all of these to help us in our formulas to find out to do everything else for the rest of the question. So this marginal costing statement, as I said, took us a few minutes to do there, but it's very, very, very important. It's very, very important for us to have it done so that we can complete the rest of the question, because it's going to impact how we do with everything else. Okay, so part A here, right, is looking for calculate the company's break-even point. Okay, so we're doing two part A. All right, so part two, company's break-even point. So the break-even point, the formula, you have to learn it: fixed cost over contribution per unit. Now, fixed cost here, 247,250. You can see that there. There's the fixed costs. Okay. Contribution per unit then, €11.50. Okay, so you're not going to get this right unless you know the formula. Okay, so 1170. Sorry, I wrote down 1150. It's 1170. Again, showing you the importance of checking things twice. Okay, so that there, very, very important. Fixed cost over contribution per unit. So 247,250 divided by 11.70 gives me 21,132 point something, but I cannot sell point something of a unit. So I have to round up and I have to make it 21,133 units. So I have to sell 21,133 units in order for me to break even. Okay, so that is to find out the break even point. I have to sell 21,133 units in order to break even. If I only sell 21,132 point something, I can't sell point something. I have to round it up. So 21,133. Then the margin of safety then. So the margin of safety is how much can my sales drop before I will start making a loss. Okay. So how much can they fall before I start making a loss? Okay. So I'm due to sell 80,000 units. Okay. So 80,000 units. But then I know that my break-even point is 21,133. Okay. So my sales can drop. It's actually quite a lot here. My sales can drop by 58,867 units before I will start making a loss. Okay, so that is the margin of safety formula. So that is that answered, right? That's part A answered. Okay, calculating your break-even point and margin of safety. Part B is saying explain what's meant by the term margin of safety and reference the figures you have used in part 2A in your answer. So even if you've got those completely wrong, you're going to be getting full marks here for this. Okay, so margin of safety is how much your sales can fall before the break-even point, is reached. Okay, so margin of safety is how much a business's sales can fall before they make a loss. Okay, so in this case it is 58,867 units. So the sales can drop by 58,867 units before it's going to start making a loss. Okay, so that is what the margin of safety is. Okay, so that's part 2 completely done. All right, so part 3, we're going to move on to part 3 now. Part 3 is a sensitivity analysis question, right? And it means, like, sensitivity analysis question is like what if questions, okay? So what if scenarios, all right? So just looking at part 3 here, it says calculate the number of units that must be sold at €30 per unit to provide a profit of 10% of the sales revenue earned from these same units. Okay, so look, what if we did this? So management use this an awful lot. Management use sensitivity analysis to, make decisions. All right, so we are going to use the marginal costing statement that we have completed, all right, to help us answer this question. So we always go back to the original marginal costing statement that we have done. Okay, so calculate the number of units that must be sold at €30 per unit to provide a profit of 10% of the sales revenue earned from these same units. Okay, so what I do all the time is I use the same formula. Sales minus variable costs minus fixed costs is equal to profit. So that's the formula that I will always use, and like it's the same as what is here in the marginal costing statement. Sales minus variable costs minus fixed costs is equal to profit. So it's nothing new here. Now, what are we asked to calculate here? We're asked to calculate the number of units that have to be sold. So we're going to go like algebra here, right? And x is going to be, we're going to use an x here, and we're going to say x is equal to the number of units. All right. So calculate the number of units that must be sold at €30 per unit to provide a profit of 10% of the sales revenue earned from these same units. Okay. So my sales, I'm gonna sell number of units, but I don't know what they are yet. Okay, the selling price is going to be €30. Okay, now this is interesting here. Now we want to get a profit 10% of the sales revenue. So 10% of 30x is 3x, right? Because that's 10% of that. Now, what I'm going to do next with you is the number one reason why people lose out on H1s in this question. Okay, so if we change the selling price from 27 to 30, right, our sales commission is going to change. All right, so if you imagine like the calculator that's in front of you there, like the sales commission on that would be different if there was sales commission on it, but the sales commission on that would be different if the selling price changed, right? So what we have to do is we have to find, right, well, what would the commission be on something that was €30, and what would it be per unit on an item that was, charging €30 instead of 27? So the variable costs without the sales commission here would be 420 plus 376 plus 320, so all of these three divided by 80,000 units, okay, and that is per unit 13.95. All right, and now we have to say to ourselves as well, right, well, what was the what is the sales commission? So like going back to the question, right, we saw that there was a sales commission of 5% of sales. So if we were going to sell something at €30, right, if we're going to sell something at €30, okay, that is going to be 5% of €30 selling price. It's going to be, right, €1.50. Okay, so we've got the original 13.95, but then we'll have the 5% of the new selling price, which is €30. Okay, so the variable costs, right, will change. Okay, so we're going to have the number of units multiplied by the 13.95, so that would be like 13.95x, right? And then we're going to minus as well the €1.50x, right? Because we don't know the number of units that are going to be sold, but we do know that the commission, right? So the commission is the 150, because that is 5% of €30, which is the new selling price that they are wanting to charge. Okay, so we don't know the number of units. The number of units is X. We don't know what it is, but we do know that the variable cost per unit is 13.95. Multiply that by the number of units that you're going to sell. And we do know that the commission is €1.50 multiplied by the number of units that you're going to sell. Okay, now it doesn't say anything about the fixed cost changing here, right? Nowhere on this does it say anything about the fixed cost. So we're going to use the original fixed cost figure here, which is 247,250. Okay, 247,250. So we can just zoom in on this now, and then we just solve for x. Okay, so we've got 30x minus 13.95x minus €1.50x minus 247,250 is equal to our profit here of 3x. So obviously then you just put the x's over to one side, minus 13.95x minus 1.5x minus 3x, because we're taking that over to the other side, and then we will do the exact same with the 247,250. That will change to a positive because we're changing sides there. Okay, and then what you're left with after you've worked out what all your x's are, 11.55x is equal to 247,250, and therefore then x is equal to 21,407 units. Okay, and again you have to round up if you need to. Okay, so that is one of our what if scenarios. Okay, so we just find out what we need to look for. In this case it was the number of units that need to be sold, right? So that is our x. Okay, you just figure out any of the changes. You have to be very careful with the sales commission. This is what is going to bring you down from a H1, okay? You have to say, okay, my selling price has changed to €30 from 27. Therefore, that means that my sales commission has changed from whatever it would be, 5% of €27, which is €1.35, and now it's gone up to €1.50 because the selling price has gone up. Okay, so that is very, very, very important to remember that, okay, because that's the biggie. That's what's gonna affect the marks there. So that's your answer, and there's usually about 12 to 14 marks for those types of questions. Okay, so that is the part 3 done. Now we'll move on to part 4. So part 4 says calculate the selling price if the company must charge per unit in 2023 if let's have a read of it. So calculate the selling price the company must charge per unit in 2023 if sales commission is increased to 6%. Sorry, I'll wait till I get this fixed here. Okay, calculate the selling price the company must charge per unit in 2023 if sales commission is increased to 6% of sales and fixed costs increase by 10%. Okay, right, so look, we've got the original marginal costing statement that we've done. We're going to write out our formula: sales minus variable costs minus fixed costs is equal to profit. Okay, right, so that's us done. What we're going to do then, we'll put any changes up on top. Now, calculate the selling price. So the SP, the selling price, is X. Okay, so selling price is X, right? Number of units. Okay, so it says the volume of sales and the profit are to remain the same. So volume of sales is 80,000 units. Okay, profit is to remain the same. So €6,887.50. Okay, so that's staying the same. So let's think about this. Now it's saying that, okay, we'll go with the easy one first, right? So fixed costs increase by 10%. So my fixed costs are going to be 247,250, right? Up by 10%. So if we multiply 247,250 by 110%, right, we will get 271,975. So that's my 247,250 multiplied by 110%. So I'll just write that there for you so that you know, okay? This here, no change, okay? Now, variable costs, right? This is the tough part, okay? So it's saying that the sales commission, okay, is going to increase to 6% of sales, up from 5% of sales, okay? So look, this is important for us to remember, right? We have 80,000 units, right? Multiplied by, let's just remember, we had a variable cost per unit without sales commission. So it was $13.95 that we worked out earlier on, okay? When we just calculated all of these three figures here and then divided them by 80,000 units, we worked out that was $13.95. Now, so I'm going to multiply that by $13.95, okay? But I'm also going to multiply 80,000 by 6% of my selling price. But I don't know what my selling price is now because it is X, right? So that means, right, to find 6% of X, I'm just going to make it 0.06X. I'm just going to turn it into a fraction, okay? So that's all my changes done. It's looking a wee bit messy, right? So we'll tidy it up now. So we've got 80,000 units multiplied by X, which is my selling price, okay? And then I'm going to minus 80,000 multiplied by 13.95, which is 1,115,000, okay? And that's euro, right? So that's euro. Then I'm going to minus 80,000 multiplied by 0.06x, which is 4,800x. Okay. Then I'm going to minus 271,975, and then that is equal to 688,750 profit. Okay. Now, we're going to do the same thing all over again. We're going to separate our x's, so 80,000x minus 4,800x is equal to 688,750 euro. I'll bring over this to this side, and that'll make it plus 1,115,000, and then I will plus this here as well, 271,975. Okay, so when I work that all out, I'll get 75,200x, and then when I add up all my euros, 688,750 and 1,115,000 and 271,975, that will give me 2,076,725, and that is x is equal to then, so we can have two decimal places here because we're talking about euros. Okay, so when it's to two decimal places, 27.62 euro, and that is what you were being asked to do. Calculate the selling price. So we made the selling price x, and so the selling price is 27.62 euro. So it's a little bit messy, but I would definitely recommend that you write out your formula in one colour. Okay, do any changes up the top, and then just do all the workings down the bottom, because it can get a little bit hectic, a little bit messy. Okay, as you can see from me doing it there. Okay, we're on to part B of the question. So this is the marginal and absorption costing part of the question. So Sky Limited produced 12,000 units of product Q during the year ended 31st of 12, 2022. 9,000 of these units were sold at €6 per unit. So that means then you've got like 3,000 that weren't sold. Okay, so you're going to have 3,000 closing stock because you only sold 9,000 of them. So it says the production costs were as follows: direct materials 80 cent per unit, direct labour €1.75 per unit, variable overhead 60 cent per unit, fixed overhead cost for the year 4,000. Now it says required: prepare profit and loss statements under marginal costing and absorption costing principles for Sky Limited. Okay, so marginal costing and absorption costing, like very, very, very similar, right? But different, obviously, because you're asked to do them separately, right? Marginal costing is basically, if you just remember from our marginal costing statement above, we separate out the fixed and the variable. Okay, so that's the only difference. Absorption costing just puts them all together, right? So what we will do here, we will do our sales. Okay, so we're going to have, so we only sold 9,000. So 9,000 multiplied by €6 per unit. Okay, so that's 54,000 when I multiply that out. Now I said to you, we're going to take away the variable costs first. Okay, so direct materials are variable, direct labour is variable, variable overhead is variable. So the only thing that isn't variable here in this table, like, is the fixed overheads, right? So we're going to take away now the materials. Now let's not forget, we actually made 12,000, okay, but we only sold 9, okay? But 12,000 multiplied by 80 cent, okay, 9,600. Then we've got the labour, 12,000 were made, okay, multiplied by 175 per unit, so that is 21,000. Okay, and the variable overhead, 12,000 multiplied by 60 cent, okay, that is 7,200. Now I'm adding an extra zero there by accident. Okay, so what we need to do then in marginal costing, right, what we're going to do is we are going to calculate the closing stock based on just the variable costs. So 9600 and 21,000 and 7,200, 37,800. Okay, that's the variable costs. Now what we're going to do here is we're going to take away the closing stock. Okay, so under marginal costing, right, we're going to work out the closing stock here, right? So if we had 9,000 actually sold, right, but we had 12,000 actually made, we only sold 75% of them, right? So our closing stock, sorry, I was writing down the wrong thing there. The closing stock is going to be 25% of that because we only sold 75% of it, right? So 37,800 multiplied by 25%, 9450. So that is 9450. That is the value of our closing stock based in marginal costing principles, because what we do is we calculate the closing stock just as whatever the percentage is on our variable costs. So these are my variable costs here. So 37,800 minus my 9450 is 28,350. Okay, take that away there, and that is my contribution. Okay, so exact same as everything we've seen before. 54,000 minus 28,350, that is 25,650. Okay, then what I do is I take away my fixed costs. So my fixed costs are 4,000. Okay, and then that leaves me with a net profit of 21,650. So that's under marginal costing principles. So you just take away the variable costs, you work out what the closing stock is based on the variable costs, you find your contribution, take away your fixed costs, and that's your net profit. Now, absorption costing, we're doing a lot the same, okay? Down to like this point here, we're all the same, okay? So it's a wee bit tedious writing it all out again, okay? So sales, less costs. We're okay to not write down our workings here, but we've got materials, 9,600. We've got labour, 21,000. We've got variable overheads, so very tedious here, 7,200. Okay, so it's the exact same down as far as that, but with absorption costing, we're going to put in the fixed costs, which are 4,000 here. Then that's going to be, okay, that's going to be 41,800. Okay, sorry, 41,800. Apologies, writing it in the wrong place. Okay, so that is all of our costs, right? All of our costs put together. But what we'll do then, we're going to value the closing stock as 25% of the 41,800, right? Because we didn't sell 25% of the stock, okay? So 41,800 multiplied by 25% is 10,450 euro, okay? Take that away then from the 41,800 and I get 31,350 euro. Take that away from my sales, 54,000 minus 31,350, 22,650 is my net profit. So 22,650. So you can see under absorption costing, your net profit is more because they factor in the fixed overheads into the value of the closing stock, right? So the closing stock is valued more, okay? Cost of sales then is more, so profit is a wee bit more there as well, okay? So that is how you do the marginal and absorption costing. Now, last part of the question, which actually was a lot of work in this particular year, 2023 year, outlining the benefits of absorption costing, right? So there is a lot to this actually. So here's the list of benefits here for 6 marks. So very likely that you know, 2 or 3 marks would be sufficient for this, okay? So benefits of absorption costing. So absorption costing is the one where all of the costs are absorbed into the product, right? So the fixed overheads, if you remember, I'll go back to this. In absorption costing, the fixed overheads were put into the value of the closing stock as well. Okay, so benefits of absorption costing. Well, all costs, variable and fixed, are recovered in the selling price charged to customers. So you've fired all of the costs into that. You know how much it costs. The closing stock is valued with the fixed cost in it as well. So look, you just know how much it cost for all of the product to be made, fixed and variable costs. It gives a more accurate valuation of closing stock at the end of financial period, and this will enable accurate accounts to be prepared. Helps managers to calculate the total cost of producing each product, which enables a business to manufacture the most profitable products. There is no need to separate costs into variable and fixed costs, which can be very time consuming and costly, and in many cases may not be possible at all. Absorption costing complies with accounting principles and standards. It matches the costs and revenues for the period, and profit is higher under absorption costing. So you can see that there, it is higher under absorption costing. All right, we have to do this in question 1. We have to use absorption costing. Okay, we have to put all the costs in. Okay, so there was a lot to that theory, and very few marks. So it just shows you, though, you can't get a H1 without knowing your theory. So you have to go over it, time and time again throughout the year in 6th year, in order to be able to identify and be able to answer the questions in June.